Hello everyone. My name is CP Otieno, and today we are going to look at our lesson 2 on Introduction to Accounting. We are still trying to build the background of accounting, and thereafter we'll be able to flow with accounting entries and even the other calculations that are involved. But for today, allow me to go straight into the first question, which is asking, what are the categories of assets? Then we shall also give the examples. So under assets, we have the first category called non-current asset. This refers to assets which are purchased for long-term use and are not likely to be converted quickly into cash. This can also be referred to as fixed assets or long-term assets. Now, you remember last time we talked about an asset and we defined what an asset is. The key points that we said we should always keep in mind when we are defining an asset are, number one, we said that an asset is something, or rather it is a resource that is owned by the business organization as a result of past economic events. Future economic benefits are expected to flow to the business from that particular item. Then that makes it an asset. The factors that we need to consider are, number one, we should check if it is an item that is owned or controlled by the business. If that is true, then the next step that we need to check, is it as a result of past economic events? Then the third point, we check, does the business expect to receive or gain economic benefit in the future periods from that particular item? If it qualifies in those three stages, then that one is an asset. So today we are defining the non-current asset, and we are saying that a non-current asset is an asset that is expected to last for more than one accounting period in the business. That is the simple definition. It is a category of assets that are expected to last for more than one financial period in the business. And we said the other time that one financial period or an accounting period simply means 12 months in a year. So we have got particular examples under this category of assets. So the examples are, we can see the examples we are having here. If you allow me to start with the first one, which is land. Now, we all know about land. And now land is an example of an asset that we expect to last for more than one accounting period. Most of the time, we don't purchase land and then we intend to sell it within the same financial period. If that is what we do, then that one, it's not a non-current asset. It is not a fixed asset. That would mean that we are operating a business that is selling land. You are acquiring ownership from another person and transferring the ownership. So it would fall under the category of inventory. Yes, but those are very scarce circumstances which we'll come to understand in future. So we have land, buildings, machinery, vehicles, office equipment, and furniture. A point to note, just like I was saying, that even the vehicles can fall under current assets, but I want to give you the distinctive characteristics that you should consider every time when you want to know how to categorize this asset. When we are talking about financial transactions relating to vehicles in a given organization, then you have to look at how they are brought into the business. I'm trying to say that vehicles can also be considered as goods. Why? When we have a company that is conducting businesses in the line of buying cars and selling them to customers, then remember, in that company, goods are the vehicles. So the products that are being sold by that company are vehicles. we have vehicles in this same organization that are expected to last for more than 12 months in the business. Those ones we consider as the fixed assets. And then there is the second scenario where the vehicles have been purchased and they are meant for sales. So the sales revenue come from the sale of these vehicles. So in that case, those vehicles become the inventory. I think that one makes it a bit clear. The same applies to all those assets that you are seeing: land, building, machinery, vehicles, office equipment, and furniture. If they are bought to be sold, if they are bought so that they can be sold to earn revenue, then we consider them as goods. In that case, it would mean that those assets are not going to be classified under the fixed asset category, but we shall put them under the category of current assets because they are expected not to last for more than one financial period. In fact, with that kind of explanation, we have just explained the meaning of current assets. It comes by default. This refers to the assets which are held in the business for less than one financial period. It refers to the assets which are held in the business for less than one financial period, less than 12 months. These assets are expected to be converted into cash within a period less than one accounting period, also called short-term assets. So we have said that current assets are also known as short-term assets. So when someone talks about current assets, remember it is the same thing as short-term assets. And we have said up there under non-current assets, we said that the non-current assets are expected to last in the business for more than one accounting period. So the opposite of that is the case under current assets. Now, the examples that we have under the category of current assets that we said are expected to last in the business for less than one accounting period. Number one, we have accounts receivable, which is the same as debtors. We also have inventory, which is the same as stock. We have stationaries. We have cash at bank, cash at hand, prepaid expenses, and we also have marketable securities. Current assets are resources owned or controlled by the business organization as a result of past economic events from which future economic benefits are expected to flow to the business, and they are not expected to last in the business for more than one financial period. And then the non-current assets would say they are those items or resources owned or controlled by the business as a result of past economic events from which future economic benefits are expected to flow to the business, but the items or the assets are expected to last in the business for more than one financial period. That is the difference. The questions that you need to ask yourself: is it something owned or controlled by the business? Then is it something that the business acquired as a result of past economic events and from which future economic benefits are expected to flow to the business? Then you ask yourself the last question that makes you categorize them under non-current assets or current assets. The last question should be, these assets or these items that we've already identified as assets, are they expected to last in the business for more than one financial period or not? So that is where you get the point to help you categorize the assets. If you've noticed that the assets are going to last for more than one financial period, we had already agreed that that one will become a non-current asset or a fixed asset or long-term asset. They mean the same thing. The current assets also after we shall have considered the assets that you are weighing, whether they are going to take one financial period or not, on realizing that the assets are expected to take less than one financial period, you make a conclusion that that one should be categorized under current assets. We also have another category of assets called biological assets. This refers to any living plant or animal owned by the business as a result of past economic events from which future economic benefit is expected to flow to the business. I will give you a case scenario that will help you understand best. And this is the one that I believe will really sink more than even the first easiest ones up there, the non-current asset and the current asset. Now we have examples as goats, sheep, cows, pigs, fish, etc. You can name them. And we also have the category of plants owned by the business. So a business can have plants that were purchased. They know the value of those plants, or a valuation may be carried out by the valuers to determine the value of these particular assets, the goats, sheep, cows, pigs, etc., and even the plants that are owned by the business. And then from that point, the business may be able to record those particular biological assets in the financial statements. When you're looking at the statement of financial position of a given business, and then you come across the term biological assets, then you will know that these people are talking about the living plant. They are talking about the living plants or the animals that are owned by that business organization. We have a case of one party called Laban. The other second party is called Jacob, who was a nephew to Laban. Then we have got two daughters of Laban, the first one called Leah and the second one called Rachel. So according to Mr. Laban, if you happened to have asked him that he names, or rather he counts to you the assets that he has in his life, then I believe he would mention to you that he had some two beautiful ladies, and that one formed an asset to Laban. Why am I saying that those were assets to Laban? Number one, we know that economic benefit was expected from the two ladies. How? When the dowry income comes to the father, then that one is an economic benefit. The two ladies were owned and controlled by Laban as a result of past events, and economic benefit was expected from the two ladies by the father. So that's why I categorized the two ladies under the category of assets. And then I will go deep and categorize them under the category of biological assets, because we cannot categorize them under non-current assets, neither can we categorize them under current assets. When Jacob needed the second lady, he was forced to work in the farm for 7 years. That one was an event so that he could be able to acquire the asset. So he worked for 7 years, and when he thought he was going to acquire the second lady as per their agreement, it turned out to be something different for him, because he didn't know that Laban really believed in the cost accounting concept that talks about FIFO, the first in, first out. So Laban believed that the first lady should be the first one to come out of the family, instead of having the last one coming out and leaving the first one in the family. So he obeyed the concept of first in, first out. So the story is long, the story goes, but then what I wanted to emphasize on is that for Jacob to be able to acquire the intended or the desired asset, he had to work for another 7 years to be able to acquire the next asset. So he came out with those two items. If you may look at it from a business perspective, he managed to acquire two assets from Mr. Laban. as a result of working for Laban for 14 years. That is the past event that we are talking about. And then he acquired the asset. So he owns and controls the asset. And maybe some benefit is expected to accrue to Jacob in the future period from the assets owned. Back to our lesson. Now we have the second question asking, what are the categories of liabilities with examples? What are the categories of liabilities? Now, just like we had categorized the assets, we can also categorize the liabilities that we have. The first category of liabilities that we have is non-current liabilities. Just like we had seen in the assets, this one, the categorization that we have this other end is the same as the one that we had on the side of assets. So non-current liabilities are those liabilities that are expected to last in the business for more than one financial period before they are settled. And then we also have examples under that category. We have the long-term loans, we have pension liabilities. Under the category of current liabilities, we have accounts payables, short-term debt, dividends, notes payables, income taxes owed, prepaid income. We said that current liabilities are those liabilities expected to last in the business for not more than 12 months before they are settled. Now, the next question is, what is a journal? A journal is a detailed account that records all the financial transactions of a business to be used for the future reconciliation of accounts and the transfer of information to other official accounting records, such as the general ledger. A journal states the date of a transaction, which accounts were affected, the amounts, usually in double entry bookkeeping method. Now, in short, what we are saying is that a journal is that book that carries all the financial transactions of a business together. We can relate this one to the definition which we gave to accounting. We said that accounting is a process of recording, summarizing, and analyzing financial transactions of a business so as to come up with the financial results which will be used to inform the economic decision of financial statement users. We underline the first bit, which is recording. We record in the journal. Any financial transaction that has taken place in the business is supposed to be captured in the journal. So the journal contains all the financial transactions. All the accounting records shall be developed from this journal. We shall do a summary and then analyze them and come up with the financial statements. Now, the next question is, what is a general ledger? A general ledger represents the record-keeping system of a company's financial data with the debit and credit account records validated by a trial balance. Transaction data is segregated by type into accounts for assets, liabilities, owner's equity, revenues, and expenses. In short, what we are saying is that we are supposed to do the groupings of the like, or rather the common items that are found in the journal. We said that a journal is a detailed account that records all the financial transactions of a business to be used for future reconciliation of accounts and the transfer of information to other official accounting records, such as the general ledger. So now we are handling the general ledger, and we are saying the information that is contained in the journal is now being grouped. It's now being summarized. Remember, we said that accounting is the process of recording, summarizing, and analyzing financial transactions. So we are now at the bit of doing the summary. So we are summarizing the information that we obtained from the journal. The journal contained everything, and now we want to pick that information and try and summarize them, or rather do the groupings, because we are intending to produce some financial reports which will be used in advising the financial statement users. So we are organizing the information. We had recorded them in the journal. Now, at the point of general ledger, we now try and group them together. The ones that relate to each other, we group them together. The next question is, what is a ledger account? A ledger account contains a record of business transactions. It is a separate record within the general ledger that is assigned to a specific asset, liability, equity item, revenue type, or expense type. What we are saying under this is that a ledger account, it is that specific account which contains the information that relates to a particular asset, a particular liability, the equity item, the type of revenue, and even the type of expense that you are having. So those small categories, the specific items that we have that constitute the financial statement, are elaborated or are detailed. They are shown out in the ledger accounts. So we have to develop the specific ledger accounts from the general ledger information. The general ledger is the record which contains the ledger accounts which have got specific entries, the specific assets, specific liabilities, equity, revenue, and expenses. We shall come to understand these three items best when we are handling them in terms of calculations. So we'll do some practical lessons after this. In the next lesson, we are going to handle some practical questions so that we can see. It's good that now we have developed the basic content, or rather the basic foundation of accounts. Now, from this point, I want to assure you that you will be enjoying the calculations that we are going to have. We have captured a number of items that we will be moving forward with. Once you've understood these first two lessons, the rest of the things will just be repeating themselves. We'll just be adding a little concept, but we are using the same foundation, or rather the basic concepts that we had started with. So check on the first lesson and this lesson. If at all you missed the first lesson, I would refer you back to that first lesson so that you can get to understand the concept. Refer back to that lesson 1. Combine it with the content that you've gathered today in this lesson 2. And I can assure you, you are going to find it very easy. Practical application of double entry concept. Double entry concept is a concept in accounting that states that for every credit entry, there must be a corresponding debit entry. Whether we have passed one credit entry against 3 debit entries, the end result should be all the credit entries summed up together compared to all the debit entries summed up together. The result should be equal. Now, this is how we are going to handle debit and credit. And now we are going to enjoy. I know a number of students do not actually like much of the theories. Even in movies, theories are always not very desirable. Yeah, but then they are being used to develop the practicals that are coming, or the actions. Now we want to start the actions. This is how we are going to start. And this is what you will master for the rest of your life as you handle accounts. It will never change unless maybe there will be some emerging trends that will force human beings to think otherwise. But for the longest time, this one has always stayed constant. So other factors held constant, I would say that this one will stay forever. And this is the bit that if you miss, then you cannot handle anything in accounts. It is a very simple bit. Just look at it. This simple bit, if you miss it, then forget it. Number one is assets. What we are talking about here is the treatment of financial transactions. When do we debit? When do we credit? Now, I will start that all assets, if you have got financial transactions that relate to any asset, then you realize that an asset is going to be increased. Pick the amount and debit it on the ledger account of the asset. When the asset is decreasing, it's supposed to be credited. So this is how we are going to go about this. It's good for you to master the pattern here. For assets, an increase in asset is debited, while a decrease in asset is credited. Under liabilities, an increase in liability is credited, while a decrease in liability is debited. Then under equity, an increase in equity is credited, while a decrease in equity is debited. Then we have expense. An increase in expense is debited, while a decrease in expense is credited. If you miss this concept, then you will still have to come back to this bit. This simple table you are seeing here, this is what guides accounts. If you are having assets being debited when they increase and another company does the opposite, then definitely you are going to end up with opposite results, and thereby you cannot be able to compare them. So I think we have said much about the application of double entry concept. You should write this one somewhere. It will help you. Once you have this bit, we can be able to move. The next lesson shall be on passing entries in the journal, the ledger accounts, and maybe looking at the trial balance. So please stay tuned. We shall handle the rest of the questions as they come, and we'll start from the simplest questions as we grow gradually to the most sophisticated questions, and we shall get to understand to an extent that we can also be able to train or teach somebody else. You pass this knowledge to somebody else. So friends, thank you for taking your time to watch this video. Consider subscribing, liking, and also remember to share with the other people that you know who would want to get knowledge, or those who would want to learn the accounting concepts. We are still moving. We just started, and now we want to move with everyone. So kindly call a friend to call a friend so that we can move together. So today, I want to appreciate each one of you who has taken time to tune in to this channel. Please don't leave without subscribing to this channel. That is the only way you can appreciate the good work that I do for you in terms of carrying out a research and then availing the result at your comfort zone. We'll be referring much to the concepts that we discussed in the first video and in this second video as we handle different accounting questions. Watch them again and again and master them. Then as we move, you will be better placed to understand all the concepts, why we are doing this and why we are not doing the other way around. Thank you so much. Stay tuned. Much is yet to come. Thank you. My name is C.P. Otieno.